when people get stimulus checks and then, they might be hot on, the exciting things and they run up again and so on. But that's going on. And of course, there's Bitcoin and other things that are going on. However, the big thing is plenty of liquidity and ridiculously low interest rates. There are two types of inflation, okay? Let me just clarify. There's supply-demand inflation, like if demand is pressing up against capacity to produce things, and maybe that's labor, maybe that's capacity constraints and so on and so forth, prices rise because of that. And then there's monetary inflation. And monetary inflation is because the currency and the value of money goes down. And so you can see, like in the 1970s, stagflation. You could see inflation is not coming from the first of those types of inflation. It is coming from the second of those types of inflation. And the way that would occur is because people don't want to own bonds. To me, it's pretty crazy to want to own cash or bonds. Okay, we can get into why that is. But if you have that movement out of like that type of financial assets to other assets, which we are seeing, then that has the effect first of causing financial inflation. In other words, an investor shifts it to another investment and they go up in value. And then that wealth effect has an effect on those items that people who acquire the money want to spend on. So maybe it's on penthouses or maybe it's on something else, but it depends how that's spent. I'm more worried about the monetary inflation, which would look something like a currency defense. It means that what happens is, as money, let's say people don't like bonds, and then they start to sell bonds. And bonds then go down in value because they have a capital loss. And they don't offer anything in interest rates, negative real interest rates and so on. They don't like that. Then the Federal Reserve or other central banks are faced with the choice of either rates rise, and that is bad for financial asset prices and it's bad for the economy, or they make the purchases. They make money and they make the purchases of that, and that then produces more of a monetary inflation. So it's the second that I'm more concerned with. But the supply demand of debt will be, I think, the big driving influence. I want to emphasize this because so many people say, okay, well, here, they look at this stock or they look at this. But what you saw was the V bottom in all markets and so on. And that was due to debt and money dynamic happening. So that's the biggest dynamic to pay attention to. I think it was April 8th or 9th. The exact same action was taken basically almost as happened on August 15th, 1971, which was also the exact same action which was taken on March 5th, 1933. In other words, the big jolt, the separation in terms of that value of money, that dynamic. And that is the new paradigm. What's happened is that a lot of, like these cycles go, a lot of new ideas, new technologies, new things come along, and they make fabulous revolutions, and they grow things. And that's great. But there's a tendency of investors to extrapolate the past and not pay too much attention to price. And when that happens, you start to emerge as somewhat of a bubble. By our measures, the bubble is not as what it was in 2000 and not what it was in 1929, but it's kind of like halfway there if I look at the types of qualities.
First is the debt money thing. How much debt and money, and what are the repercussions? How does that pass through the economy? What does that mean for markets, inflation, and so on? We're in a different era now. Zero interest rates, produce a lot of debt and monetize it. Second influence, the conflict, internal conflict over wealth, left-right conflict, that conflict. And then the third is the rising of a great power in the form of China, challenging an existing great power and challenging the existing world order. Those three things are coming together at the same time as then we have a pandemic. So I think each one of those is a cycle. What's happening now has not happened before in our lifetimes, but has happened in the 1930 to 45 period. I went went back and studied it
Yes,
over
you have.
500 years, and so it's that context. So I think if we're talking about anything, we should look at that. There's not enough money to go around, right? We're spending a lot more than we're earning, and we have to do that partially because of this social redistribution, that necessity, and they can't take it all from taxes. And what that means is the printing of money. So it's the mechanics of that. So what you do is you get more money, and so that devalues the value of money. In other words, cash is trash. This is guaranteed. You are not going to have an interest rate that's going to compensate you anywhere for inflation. So you have to look at the cost of the money, right? And so that interest rate, whether it's the bond rate or whether it's the cash rate, certainly, you're not going to get that. And so we have this wonderful sugar high, which is to distribute the checks and so on. But that means everything else goes up in relationship to cash because it's better to borrow cash. That's just mechanics. So we have that dynamic underway. So we produce inflation. But what you do know is that interest rates must be below inflation rates and must be below the nominal growth rate in order to deal with all of that debt in order to finance it. And that depreciates the value of cash and money. So you have to invest it elsewhere. That's the dynamic, right?